What is beta? Beta is a way of measuring a stock's volatility compared with the overall market's volatility. It is used as a measure of risk and it is an integral part of the capital asset pricing model CAPM, which is the model that measures the return of a stock. A positive beta value indicates that the stocks generally move in the same direction as that of the market and vice versa. This helps the investor to decide whether he wants to go for that riskier stock that is highly correlated with the market or with the less volatile one. The market as a whole has a beta 1. Let's understand what this means. Stocks with a value greater than 1 are more volatile than the market, meaning they will generally go up more than the market goes up and go down when the market goes down. For example, if a stock's beta value is 1.3, it means theoretically the stock is 30% more volatile than the market. Stocks with a beta of less than 1 have a smoother ride, as their moves are more muted than the market. But they'll usually still go up when the market goes up and down when the market goes down. Have you known about this concept before? Comment below.